Hey everyone, me Kevin here. If you're like me, then you want to know what the Federal Reserve thinks about the next potential market crash coming or not coming, or when's it going to come or when's it not going to come. We want to know this so we can prepare. This is why it's such a hot topic on YouTube, because we want to know if a market crash is coming. We want to get ready so we can go grab a cup of coffee, go grab some sparkling water, and go shopping for some deals. It entirely makes sense. So let's go ahead and listen to Richard Clarida, the Vice Chair of the Federal Reserve. He's going to give us some insights. Now, he's going to start by talking about what it means in terms of when they're going to slow down their purchases, aka when are they going to stop printing money. When you hear asset purchases, just think brr, okay? And so we're going to get his first indication on when they're going to slow down with that. And then he's going to talk about double-dip recession and his expectations for that. Now, if you want to build wealth, make sure to use the holiday coupon code linked down below for the courses on stocks and real estate and making money with YouTube videos. Remember, you can email me for a bundle coupon code at kevin@meetkevin.com. Get that holiday sale going on. Take advantage of it. All right, folks, here we go.
I think the big question out of the Fed meeting this week that hopefully you can clarify is, what does substantial progress look like on your goals so that you would consider paring back the asset purchases?
Well, Sarah, I think the chair said it very well. Substantial progress means we want to make substantial progress to reducing unemployment and moving inflation back close to our 2% goal. The coronavirus dug a deep hole for the economy. The recovery so far has been robust. There's a way to go. And so substantial progress obviously will come into view as we get closer, but that's a ways away. So right now the focus is on providing the support the economy needs to get us through this tough stretch.
Okay, so tough stretch coming up. There's still going to be printing money for the foreseeable future. I think it's funny that, when they say, oh, well, we're going to wait to stop printing money until there's been substantial progress towards, a recovery. Basically what they're saying is we're just going to keep printing money until we have no idea when. We can't tell you because we don't know. We're just going to keep printing money. That's why he said we're going to keep printing money until that progress comes in view, aka it ain't yet. We're going to keep printing.
But I guess it does feel a little ambiguous, Mr. Vice Chair. Why not set specific markers so that it is actual guidance?
Well, Sarah, we set specific markers for interest rates at our September meeting, and we think that it's appropriate with regards to the asset purchase program to put down markers in terms of substantial progress, as we've indicated. And again, our communication, our SEP projections, as we get closer to that point, it'll become clear. We think right now this is the best way to communicate our goal to really provide the support the economy needs right now.
Okay, pause right there for a second. He said a lot of things there. Basically, he said, yo, Sarah, we told you we're going to keep interest rates low until 2023 and 2024. I used a bunch of acronyms like SEP, which stands for Summary of Economic Projections, but the bottom line is we told you we're going to keep rates low until 2023 to 2024, because that's exactly what they told us in their SEP. So he's kind of reiterating, hey, look, the goal is to keep rates low. I'll go ahead and pull up the SEP really quick, just so that way if you haven't seen that before, you could get a quick look at what that looks like. Here you go. Here's a realistic example. What you really want to do is you want to take a screenshot of this right here. Here, post for your screenshot. Take a screenshot of this. They're literally telling you what their projections are for the GDP, for the unemployment rate, for inflation. These are their estimates. And you can dive deep into this if you care to, like, oh, this is our dot plot for what we think interest rates are going to be going forward, and this is our distribution of participants' projections for change in real GDP. Basically, what I showed you in that first picture there where I told you to take a screenshot, that's their summary of economic projections. Okay, I'm getting the jargon out of the way. What do you freaking think about a double-dip recession, all right? Can you get to that already?
No.
There was some surprise and maybe a little disappointment that the Federal Reserve didn't go even farther, perhaps increase the weighted average maturity, focus on the long end of the curve. Why did you decide not to do those things, which would have been considered stimulative at a tough time?
Well, Sarah, we think we are providing very ample support for the economy with the combination of our guidance and these purchases, which are at a very, very robust pace, $120 billion a month. We think that the interest-sensitive sectors in the economy, autos, durable goods, business investment, are all responding to low rates. The contact intensive service sector obviously is being hampered by the virus. And we think that the current constellation of policy is exactly where we want it to be. Chair Powell also indicated, Sarah, at the press conference that, of course, in future meetings, we're going to be assessing the situation. And there are things that we could do with regards to the maturity of our portfolio. But right now, we like the setting of where policy is, and we think it is providing very important support to the economy.
Okay, so basically, we're happy with our money printing right now. We're doing good money printing. Double dip, please.
One of the worries is the near term, and we've seen it already deteriorate. Retail sales, jobless claims. How likely is it that we could be looking at a double dip recession?
Well, Sarah, I certainly hope we don't have a double dip, and I don't think we will have a double dip, but you are correct. The surge in hospitalizations and new cases is clearly impacting the economy. We're seeing it in some of the data that you've referenced. And as we've said, we could have a rough couple of months in the data. But on the other side of this, of course, we've gotten very, very positive news on multiple vaccines that are not only safe, but effective. Indeed, this week we began to have those vaccinations deployed. That makes me individually very optimistic about the economy as we get into 2021. Indeed, I and most of my colleagues revised up our outlook for the economy over the medium term, over the next several years, notwithstanding we acknowledge what could be a rough couple of months because of the increasing cases.
That's actually big right here, right? This is kind of echoing what we heard Federal Reserve Chairman Jerome Powell say, when he had a speech on Wednesday, where Jerome Powell's like, this could be the start of a new bull run. I mean, Jerome Powell's like, real estate crash? Nope. Stock crash? Nope. PE ratios for stocks? Not a problem because rates are low. Housing prices high? Not a problem because rates are low. And part of me is like, wait, seriously? Like, Jerome Powell, are you just trying to like prop up the market? Like, are you just blowing smoke, man? Well, then when I kind of do some calculations and I'm like, crap. Wait a minute. The Economist says 25% of all currency that is in circulation today was created by central banks in 2020 to prop up the markets. And rates are at ridiculously record lows. It's hard to even say record lows anymore because it's like we keep hitting new lows. Anyway, when you combine those two things, it's like, I guess it kind of makes sense. It still feels rough to pay some of the prices like Tesla $675 post-split. I remember being nervous about paying $675 for Tesla pre-split. It does feel weird. But now we got Richard Clarida echoing again. Hey, basically reiterating what Jerome Powell says, and his buddies are like, no, we actually think, look, we're going to go through some crap here in the next few months with deaths and the virus and waiting for the vaccine. But beyond that, we got good data coming out on the other side is our expectation. And we don't see a double dip recession coming. I mean, I'd love to go shopping for deals again, but, it kind of makes me feel like maybe we're not going to see that. And we have to adjust to this new sort of long-term normal. I mean, part of me sits here wondering, like, am I going to be looking back and me having filmed this video in 2024 and look back to 2020 and thought, damn, I should have just gone like all in, I don't know.
Well, the other factor there, of course, is fiscal stimulus. And I know that you and Fed Chair Powell and so many other economists have called for Congress to do something. They're discussing it. The latest hiccup is actually a new provision introduced by Pat Toomey, Republican senator from Pennsylvania, who actually wants to include a provision that would not let the Fed revive its emergency credit lending facilities. Would that be a mistake?
Well, Sarah, obviously, I'm aware that those conversations and negotiations are ongoing on Capitol Hill. I'm not a party to them, so I won't have anything to say on that beyond what we have already said, that Secretary Mnuchin, as Treasury Secretary, has indicated that the Treasury would like the programs to end as of December 31st and for the Fed to return the unused Treasury investment, the CARES Act appropriations, and we will do that. But beyond that, I don't have anything more for you on the current discussions on Capitol Hill.
Well, leave the discussions aside for a second. Would it be dangerous if the Federal Reserve legally were not allowed to revive those credit facilities in the case?
She's good. She's asking the same question from the opposite direction. Remember, these 13.3 facilities have to do with those 5 Federal Reserve lending facilities. That's what's holding up stimulus right now. I hate these programs. The programs were stupid. They were totally underused. I mean, heavily underused. The municipal credit facility was barely used. In fact, here, I got it right here. Look at this. This is the municipal liquidity facility. Only 0.2% was used. The Main Street lending program, we had $6 billion out of 600 used. That's 1%. We had 18% usage at the secondary mortgage corporate credit facility, which was like the corporate bailout, the stock market bailout. 0 used in primary, 3.8% used for the term asset-backed securities loan facility. Like, these facilities had such little use relative to the money that was available for them. Now, I'm not saying that they weren't useful, but gosh, just stop talking about these facilities.
That the economy and the markets would need them.
Well, we have said, and we do believe, that the 13.3 facilities, which are only really triggered in what are called unusual and exigent circumstances in the legislation, were very important, provided very important support to the economy. So there's no doubt that the 13.3 facilities were very valuable and certain.
I'm going to quickly say, he's not wrong. And I should have said this up front, but the programs had more of an impact in that because they existed, the market had confidence. So they were really like symbols. Like, we're here! And then the market functioned normally again. The Fed is worried that if they don't have that ability to go, we're here, that in the next crash, they're going to have to wait for Congress to act. And that could actually potentially lead to a deeper market crash. Because think about the Fed, when they acted at the beginning of March in 2020, they came out like instantly. They came out on a Sunday. I think it was like March 6th or 7th or something like that. It was the Sunday. The first week in March, it was a Sunday. And they dropped rates to 0. They talked about backstopping the market. They did a lot to say, hey, we're going to help the markets right away. There is a risk that if the current congressional negotiations basically take this power away to create these emergency lending facilities with the Treasury Department before Congress even acts, that potentially we could have a deeper market crash in the future. So he pretty much ends it on that note. But I want to ask you, if the Federal Reserve doesn't have those lending powers in the future, is it possible that when that next recession comes around, we could see a deeper crash, a deeper recession, because the Fed won't be able to, emergency lend their way out in the same way that they were able to this time? Is that going to be a problem? Do you believe him when he says we're not going to see a double-dip recession? When do you think the market's going to crash again? Personally, I'm on what I call catalyst hunt. I'm like, okay, so we got some uncertainty maybe coming up for January 5th on the election. Maybe there'll be some riots on January 6th, but what else? I'm running out of negative catalysts here to say there's a crash coming. So I guess that just means it's time to go all in at all-time highs. I don't know. It always feels like it's always all-time highs. Anyway, let me know what you think in the comments down below. Thank you so much for watching. Email me for that bundle coupon code, or just use the holiday coupon code down below, which will expire the night of Christmas Day. Thank you so much for watching, and folks, we'll see you next time.